Next on stage, it's my pleasure to invite Dr. Paul Gruenwald to deliver his keynote around how 2024 macro is all about the landing. Dr. Paul is the Chief Economist at S&P Global Ratings. He leads the global macro team at S&P, which provides a forecast, narrative, and risk scenarios that supports more than 1 million credit ratings in the marketplace. Ladies and gentlemen, allow me to welcome on stage Dr. Gruenwald. Thank you.
Thank you very much. Excellencies, distinguished guests, ladies and gentlemen, it is a great honor and privilege today to be here for the 17th annual GPCA Forum in Doha in this spectacular venue. My job here today is to take you through our global macro view, and following on that excellent opening presentation we saw a few minutes ago, I want to spend a couple of slides at the end talking about our thinking around sustainability and the energy future. Let's see if we can get my slides up here. I'm not sure what's happening. There we go, global macro. So this, as I was introduced, my team's thinking about global developments, and this is the macro view that sits behind all of the ratings that S&P Global puts in the marketplace, but it's also shared across our company, and as we know, there's a lot going on in the world right now. So let's think about what are the major macro drivers that are not going to just impact everyone, but this forum and this industry in particular. So growth is actually quite uneven right now. We continue to see very strong growth in the US. I'm based in New York, and US growth is still trending about 5% in the last quarter, which is quite strong. We know that growth is weaker in Europe. It's close to zero, and we know that China's been struggling a bit to get its growth back to its historic trend. Labor markets are tight everywhere. That's good in a way, but we want to make sure labor markets and wage growth are compatible with price sustainability. We know global trade has been pretty flat, so economies that are based on trade, some of the more open tiger economies in Asia, might be struggling a bit right now. But the last 2 years have really been about inflation. We had the highest inflation in 4 decades. It's now coming down. I'll be talking about that. I'll be talking about monetary policy. We have the fastest rate of policy rate increases in also 4 decades. We think those rates are plateauing, and we're going to start a easing cycle probably late next year. Looks like markets and policymakers are pretty aligned right now in terms of where we think rates are going. And then we have to talk about the landing. So we've had a spike in inflation. We've had very fast rise in policy rates. Many economies are growing too quickly. So how do we get back and land on the sustainable path? So my team has to cover the global economy, so we like to focus a bit at the start on the big three. So this slide has the narratives for the US, the Eurozone, and the Chinese economies. As I mentioned, the US is kind of a classic overheating problem. Let's think of the US economy's speed limit, which is about 2% growth. As I just mentioned, the US economy is growing by about 5% in the third quarter. The labor market's very strong. The unemployment rate is below 4%, probably needs to be a bit higher to give a sustainable wage growth. We know that we have a big investment push in the US on the back of the Inflation Reduction Act. As this audience knows very well, that act is not about inflation. It's about the energy transition and big pushes for green hydrogen and battery storage and carbon capture. We're seeing some of those investments starting to come to fruition. So we do think that the US economy needs to slow, but we have a good medium-term story. Europe, as I mentioned, is flatter. Monetary policy actually works faster in Europe than it does in the US. In the US, we have a lot of fixed-rate mortgages. We have a maturity wall where companies borrowed when rates were low, and that's coming up. We have commercial real estate, which has longer-term interest rate contracts. So it takes a while for rates to feed through in the US. In Europe, it's faster. So the ECB and Christine Lagarde have already said that interest rates are working through the European economy. We have zero or slightly negative growth in Germany, still some positive growth in Spain and other countries, but we're already seeing the bottom of the European growth slow down, and we may start to see a bit of a pickup. So we're a little bit out of phase with the US. And then China. I spent a lot of time in Asia, about 17 years. I just came back to New York about 4 years ago, and most of us are used to the Chinese economy growing by 7 or 8% and being the engine of global growth. We still think China will be the engine of global growth for a while longer, but at slower rates. So we see China growing at about 5% rather than 7 or 8%. We know about the struggles with overinvestment in the property sector. So the Chinese authorities are trying to keep the growth rate up, but also instill some discipline with the property developers, and we'll see how that balancing act plays out over the medium term. But China will continue to be the #1 driver of global growth, we think, for the foreseeable future. So let's talk about inflation. As I mentioned, inflation peaked probably about a year ago, and we like to divide inflation into 2 buckets. We think about overall inflation. That's what households and businesses face. That includes everything. Then we have core inflation, which is really what central banks are thinking about. Central banks don't control everything, so when we talk about core inflation, we typically take out food and fuel, since those are determined in global markets, and the central banks focus on the core. The interesting thing right now is that core inflation is actually higher and stickier than overall. So we've seen energy prices come down a bit, we've seen food prices come down a bit, so overall inflation has come down. But core, which is where the policymakers want to target their efforts, still remains about 4%, and most central banks target 2%. So there's actually some more work to do, which is why we think central banks are going to keep policy rates at or around current levels until the middle of next year. We think the European Central Bank is done. The Fed is probably close to done. We may have to do one more rate move, but the fast rate cycle, 50 basis points, 75 basis points, in the case of one central bank, Canada, was actually 100 basis points. That is definitely behind us. So we're at the plateau, and we'll think about starting to cut rates probably about the middle of next year. I mentioned labor markets already, so this slide should be read up and down. These are the unemployment rates for some major economies over the past 4 decades. So the way to read this chart is if you look at the US there on the left, that range there from about 15% down to about 3.5%. That's the range of unemployment over the past 4 decades. And the gold diamond there, that's where we are now. So if we look at it from a historical perspective, we can see that labor markets are still quite tight. This is the major factor in determining whether we get a soft landing or not. So we've all heard about the soft landing. That means we gradually approach our sustainable growth path. If labor markets remain strong and wage growth remains strong, we think central banks can guide their economies to a softish landing. If we start to see a big drop in employment and a big spike in unemployment rates, that is the evidence that we're going toward a harder landing. History has not been kind to this view. Most slowdowns actually have a hardish landing or a recession, but we think this time the probability of getting a softer landing is pretty large. And you can see there all the major economies here, the Eurozone, the UK, Australia, Canada. We've got historically low unemployment rates, which is great for households, great for businesses, and we'll see if we can maintain that as we go through the slowdown. I've mentioned policy rates a couple of times, so this is where we are now. I've got the end of 2022 and the most current readings in dark blue on this chart. We don't need the end of 2021 because everybody was at zero. So you can put a zero in for everybody 2 years ago. But again, we've had a very fast pace of rate hikes. Those are now working through the economy, through asset prices, through borrowing rates, through spreads, through exchange rates. All of those things together create what we call the financial conditions. So we want financial conditions to be tight enough to slow economies down, but not too tight to cause recessions. These lags in monetary policy. So when the Fed or the ECB or the Bank of England, when they change the policy rate, that has to work through the markets, and that's what actually slows the economy down. So central banking is difficult because we're moving one lever, but then we have the market reaction, and then we have the actual response of the economy. So we're in a tricky period now where the official rate hikes are done, but the markets are still digesting all of that and see if the economies can slow in an orderly way. I don't like lots of numbers, but my team just put out a new forecast last week, so maybe the best way to look at this chart is to focus on the right. Those colors are whether we have moved the growth rates up or down relative to our last forecasting round. We've been having the same experience all year long where the current period turns out to be stronger than we think. So the 2023 column there tends to be green, and we've pushed the slowdown back out into the future. There aren't really too many adjustments for this current round. If you look at the bottom line, where the world growth rate is, that's about three and change this year. Again, 1/3 of that's coming from China alone. But we've raised our growth forecast a bit for China. India, we could talk all day about India and what a good growth story that is. We've raised rates a little bit for Mexico as well. So the emerging markets have a little bit better story than last time around, but again, not much change in the US and Europe. You can see very importantly there at the top, the US has to slow below its sustainable rate. The US cannot grow by 2, 3, 4, 5%. That's not a sustainable rate for the US. It's going to cause too much inflation and financial instability. So we need the US to slow down, fall below 2% for a while, and then get onto its sustainable path. Same story for Europe, where we think the sustainable growth rate for Europe is a bit lower than the US, about 1.5. So what are the main macro credit risks that we are talking about? I mentioned earlier this really strong performance of labor markets. We continue to be surprised by the strength of labor markets. We actually think that's an upside risk to the forecast. The Fed and other central banks are trying to slow their economies, slow labor demand, moderate wages. So far, they haven't been very successful. Part of that story is good because households have good wage gains, but the wage gains need to be compatible with low inflation. Let's remember, most central banks are targeting 2% inflation rates, and we're still at 4%, so we need to slow things down. Another risk for the global economy is high US dollar and high US interest rates. This part of the world, the GCC, tends to be long dollars, so maybe that's not such a bad story. But if we think about emerging markets that need to borrow in dollars, or they're worried about capital inflows to finance their deficits, a strong US dollar is a challenge. So countries that need to borrow in US dollars are going to have to pay more in local currency. Countries that are dependent on capital inflows are going to have to attract those flows. And if the US interest rates are high and the US growth story is relatively rosy, which it is now, capital will tend to stay in the US or move to the US rather than those emerging markets. So that's a risk as well. And then geopolitics is always an issue. We still have a land war in Ukraine. We have the tensions between Israel and Hamas. So those things so far have not had a big impact on global macro, but obviously they are things to continue to watch from a risk perspective. Now I want to share with you a little bit of thinking around the energy transition. We all know there is another conference going on in Dubai as we speak. I was there yesterday, but My team has done a little thinking on the energy transition. Economists, by the way, I don't know how many economist friends you have or colleagues, but economists came very late to this idea of sustainability. So when you ask an economist of my cohorts, some of the older guys, how they think about economic growth, it's all about accumulating things, right? So we accumulate capital stock, right? We build plant, we build equipment, we build infrastructure, we accumulate human capital, we accumulate education, we accumulate knowledge, and we didn't pay too much attention to what we call natural capital or the environment. It was always just kind of there in the background. So this holistic thinking that we're now all doing, I think, is an improvement in economics. So we need to not only think about growing and accumulating, we also have a stewardship role to maintain our capital stock, maintain our environment. I think the videos we saw earlier did a nice job of explaining that. But what does that actually mean? So my team does forecasts, short-term forecasts for our ratings business. We've got some longer-term forecasts thinking about the energy transition. So I want to present to you a few key issues for us around the energy transition. The first issue is technology. We've already heard about technology this morning. We've got two transitions going on. We have to decarbonize the fossil industry, and then we need to build out the renewable industry. A lot of the projections and a lot of the gains we need in getting emissions down depend on technology. And again, if you think about green hydrogen or carbon capture or battery storage, there are a lot of things that are kind of bubbling along in the early innovation stages. We're looking for speed and scale. So there's a natural trade-off between economic growth and environmental sustainability. So technology improves that trade-off. So as we continue to invest in technology, as we continue to figure out new ways to decarbonize, that improves the trade-off between growth and economic activity and the environment. So the technology piece has to be part of the solution, and given what my team's looking at and given what S&P is following, I think there's been some cause for optimism on the technology side, but again, as we've seen so far this morning, there's a lot more that needs to be done. The second part of the energy transition is financing. So the climate is a global public good. We're going to need all countries to participate in the energy transition. As many of you know, in some of the more industrial advanced economies, energy efficiency has actually been improving. So the energy per GDP path is actually declining. But in the big emerging markets, I'm thinking about China and India in particular, they still need to make more progress. In a whole bunch of countries that we now call the Global South, that transition needs to be financed as well. So there's enough money out there in the world, there's enough dry powder out there in the world, but as we go through the transition, we have to make sure that the financing is available to all the countries that need it. That could be a bigger role for the multilateral institutions. I spent many years working for the IMF. I spent 16 years there. I also spent a little bit of time at the World Bank. So those institutions and other multilaterals are going to have to play a critical role in helping to get the financing to the Global South. They don't have the resources to solve the problem, but financing from those global institutions can help to catalyze private sector inflows, which are ultimately going to do the heavy lifting in financing the transition. And then the last one, which I think is equally important, is about distribution. This chart that I'm showing you right now is actually famous in some economic circles. It's called an elephant chart. So if you look at that chart, it kind of looks like an elephant. This is actually the distribution of gains from globalization. So this is the version from The Economist magazine. An academic from NYU, New York University, actually developed this idea. But I don't know if this has a pointer, maybe not. The gains from globalization were not uniform, as we all know. So if you look at this chart, 0 is the poorest person in the world, and 100 is the richest person in the world. So the lines there show the percentage gains in income from globalization. And the average for the chart is about 25%. So on average, the world did very well around globalization, but you can see that there's the hump in the elephant. Those are the emerging markets of Asia, who were big winners from globalization. The bottom there is the industrial workers in the US and Europe. They did not do very well at all from globalization. And then the trunk of the elephant at the very top, that was the global higher income group. So the reason we talk about this is these transitions can be very disruptive. And although the transitions make a better world, the gains are not spread evenly. There's going to be winners and there's going to be losers. So anybody who tells me that the globalization or the energy transition or anything else is going to be win-win, I get a little bit suspicious. So we have to be prepared to help the people who do not do very well in the transition. The transition is something we need to do, but the gains are not going to be spread evenly. If we don't make sure that the gains are relatively even, we're going to lose support and it's not going to happen. So that was the backlash against globalization, and that was something we need to guard against as we go through the energy transition. It's absolutely critical to do it, but it's also very critical to make sure we bring as many people along as possible, because we need the political support as well as the technology and as well as the financing. So finally, this is my shameless self-promotion, but my team produces a LinkedIn newsletter. So everything we produce on macroeconomics, around credit, we have we support our sustainability division and everything else. So if you want to read some of the research around S&P macro, S&P credit, S&P sustainability, please sign up for our newsletter. We would love to have you as supporters. So it's been great to talk with all of you today. I'd like to wish you a very successful forum here in Doha. I'll be hanging around for a couple of days during the conference, so I'd love to catch up with all of you. But thank you very much for your attention.